Warren Buffett wrote a $35 billion check for a single stock. Not a fund, not a basket of assets, one company. And the reason he did it will completely change how you look at this name. There's something buried inside this position that most analysts completely missed. They looked at the price, they looked at the earnings, they moved on. But Buffett saw something else. Something structural. Something almost invisible if you're not looking in the right place. By the end of this video, you'll see exactly what Warren Buffett saw in Apple and what it could mean for your own portfolio. Let's start with the raw weight of this move, $35 billion. To put that in perspective, that's not a bet. That's a conviction statement. At peak weighting, Apple represented roughly 40% of Berkshire Hathaway's entire public equity portfolio. 40% in one stock. From a man who built his entire reputation on diversification and margin of safety. That alone should make you stop and ask, what does Warren Buffett know that the rest of Wall Street is pricing wrong? Here's where it gets interesting. Buffett has been famously, almost comically, resistant to tech stocks his entire career. He passed on Microsoft. He passed on Google, twice. He once said he doesn't invest in businesses he doesn't understand. So when he starts loading up on a consumer electronics company in 2016, everyone assumed it was a mistake. A value investor chasing momentum, a dinosaur playing catch-up. They were wrong. Buffett wasn't buying a tech company. He was buying a consumer franchise. And that reframe, that single mental pivot, is the key to the entire thesis. Think about it this way. When you buy an iPhone, you're not buying hardware. You're buying into an ecosystem. The App Store, iCloud, Apple Pay, FaceTime, AirDrop. Each service deepens the lock-in. Each accessory, AirPods, Apple Watch, iPad, extends the relationship. Switching costs go up every single year. That's not a technology moat. That's a consumer brand moat. And Buffett has been investing in consumer brand moats his entire career. Think Coca-Cola, think American Express, think Gillette. Buffett has always paid premium prices for businesses where customers come back. Not because they have to, but because the switching cost, psychological or financial, is simply too high. Apple is the digital version of that exact playbook. Now here's where the data gets even more compelling. Apple's services segment, the part of the business that most casual investors overlook, has become a growth engine that reshapes the entire valuation story. We're talking about recurring high-margin revenue, the App Store, Apple Music, Apple TV+, iCloud storage, AppleCare. Historically, services revenue has carried gross margins significantly higher than hardware. When you model out the long-term cash flow of a business with that kind of revenue mix shift, the numbers start to look very different from a traditional consumer electronics play. And that's exactly what Buffett is. First and foremost, a cash flow investor. Here's a question most retail investors never ask. What would it take to replace Apple in your life? Not just the phone, the photos, the messages, the health data, the payment history, the subscriptions, the muscle memory of an operating system you've used for a decade. The answer, for most users, is more effort than it's worth, and that answer gets stronger every year. But let's be intellectually honest here. There is a bear case, a serious one, and ignoring it would be doing you a disservice. Here's what could make this entire thesis wrong, and it's not competition from Samsung. It's not a recession. It's regulation. Governments around the world, the European Union, the U.S. Department of Justice, South Korea, Japan, are actively targeting Apple's App Store model. The core argument, Apple charges a 15 to 30% commission on all in-app purchases, and developers have no alternative if they want to reach iOS users. Antitrust regulators call that an abuse of market power. If regulators succeed in forcing Apple to open its platform to third-party app stores or dramatically reduce its commission structure, services revenue takes a direct hit. Not a rounding error, a structural hit to the highest margin part of the business, the very part of the story that justifies the premium multiple. That's not a theoretical risk. That's an active legal battle playing out in real time across multiple jurisdictions. And then there's China. Apple manufactures the overwhelming majority of its devices there. It generates an enormous share of its revenue there. And the relationship between the U.S. and China has never been more uncertain. A supply chain disruption, a trade escalation, or a domestic Chinese preference for homegrown alternatives like Huawei. Any one of those could put serious pressure on top-line revenue. Buffett knows this. He said it publicly. He reduced Berkshire's Apple position meaningfully in 2024, a move that sent tremors through financial media. The man who called Apple probably the best business I know in the world was trimming. That asymmetry between the compliment and the action deserves your full attention. So what's really going on? Is Buffett losing conviction in Apple? Or is this portfolio management, tax efficiency, concentration risk reduction, preparing Berkshire for a post-Buffett capital allocation strategy? The honest answer is, we don't know for certain. And that uncertainty is priced into every share. Here's the bottom line, the actual verdict. Warren Buffett's $35 billion Apple position was never really about an iPhone. It was about brand loyalty as a financial asset. It was about switching costs as a moat. It was about a services business with recurring cash flows hiding inside a hardware story the market was undervaluing. That's the insight most people missed. Not the product, the psychology of the product. The bull case rests on three pillars: ecosystem lock-in that compounds annually, a services segment that continues to expand margins, and a capital return program, buybacks and dividends, that mechanically increases earnings per share over time. When a company that generates this level of free cash flow is also aggressively retiring shares, every remaining shareholder owns a slightly bigger piece of a slightly more profitable business every single quarter. The bear case is real too. Regulatory headwinds that target the highest margin revenue stream, geopolitical exposure in China, and a valuation that leaves very little room for error if growth decelerates. The question you need to sit with isn't, is Apple a good company? Of course it is. The question is, at what price does the story stop making sense? That's the question Buffett himself started asking in 2024. And it's the question every serious investor needs to answer for themselves before making a move. Now here's a question I want to leave you with. Drop your answer in the comments. If Buffett continues trimming Apple through 2025, does that signal a broader concern about tech valuations? Or is it strictly a Berkshire-specific portfolio decision? I genuinely want to know what you think. This video is for educational purposes only, not financial advice. Always consult a qualified financial